shares continue to rise. At the end of last week, we've seen the benchmark S&P 500 now officially enter a bull market. And of course, remember, a bull market is a gain of 20%. So the US share market is now officially up in a bull market from its April 7 low. The Aussie share market, not quite there yet. The Aussie market is up about 14% from its April low. But remember, we've seen significant monumental moves in stocks last week. In the US, Tesla gained 17%, Nvidia rose 16%. Other stocks like Lululemon, Micron Technology, they rose 15 to 7% last week in the US. And down under in Australia, lithium was all the rage. Liontown Resources gained almost 30% last week. Mineral Resources, that also sells lithium, they rose 25%. But ladies and gents, alarm bells, they're now ringing. Caution is creeping in. The rally in stocks could be due for a haircut because of that downgrade by Moodys. Here's everything you need to know and consider. My name is Jessica Amir, a market strategist with Moomoo. It's great to have your company on this 19th day of May. So stocks are roaring higher, but they're hitting a stumbling block. Why? Well, Moody's downgraded the US's credit rating. Basically, the agency dropped the status of the world's biggest sovereign borrower, dropping their rating from the highest possible investment grade, AAA, down to a rating just below that, AA1. Now, it's still deemed to be an investment grade economy or credit provider, the US, but nevertheless, it's still a downgrade. And I think it's important to recognize this and what it symbolizes. It basically just suggests the US is facing pressure from higher interest payments. They've got higher payment ratios because they're paying significantly higher debt. And this is why Moody's downgrading the US. It's actually the third ratings agency to do this. And this is because, of course, concerns are mounting about the US's budget deficit. The US's budget deficit, remember, it's $3 trillion. That's 6% more than the US is making in income. So that's a concern. Now, we all knew that this was about to happen because, of course, remember, we did have Janet Yellen raising the alarm bells right before Donald Trump was inaugurated. So we've got concerns getting louder about rising US government debt piles, soaring borrower expenses. This does need to be addressed. But what does it mean for us this week? And what does it mean for you and I as investors? Well, it means that gold is probably going to gain increasing shine. Of course, remember that gold traditionally does well, as in it rises when credit concerns rise. And of course, equities are likely to come under pressure, probably come under pressure this week because that traditionally does happen when we do get credit crunch concerns. So it could take a couple of days or maybe even weeks to unpack and digest this. But do keep in mind, if we do see stocks step lower and take a stumbling step down, it doesn't mean that the bull run or the rally is over. I do think that if we do suffer a setback, it's going to be short term. And the reason that I do think that stocks can go higher over the long term, I'll be covering in a sec. But what are the stumbling blocks this week that we need to watch out for? Well, firstly, we've got several Fed speeches that we'll be listening to and reading about. Secondly, in Australia, we've got the Reserve Bank of Australia meeting. They're expected to cut interest rates by 0.25% on Tuesday. Now, if they don't do that, that'll particularly upset tech stocks and real estate stocks that have been roaring back higher on expectation the RBA will cut. And lastly, what else do we need to watch out for? Well, there's several economic prints that'll be released. Now, as long as nothing upsets the apple cart this week, stocks may be able to stay higher. But secondly, do note that why else am I saying that the bull market could be intact over the long term? Well, last week we saw stocks making big moves, and that's because we saw the largest amount of buying in stocks in 5 years. Now, a lot of the buying was called short covering, as in people were being essentially forced to buy stocks because we've seen stocks rally up so hard and fast. But this is called a short squeeze, but I don't think, as Goldman Sachs alluded to as well, this is not just a short squeeze pushing up stocks, but importantly, we are seeing retail investors, as in mum and dad investors, they're buying. They're buying record amounts of stocks and ETFs. In fact, $25.2 billion of stocks was bought last week. And we've also seen record amounts of ETFs be bought as well as shares. And so shares are on course for $416 billion in inflows so far this year. And if we think about this in perspective, this actually makes this the second biggest year of stock buying that we've seen on record. And if you look at one of the world's biggest ETFs, it goes by the ticker code of VOO, that cleared a milestone as well, taking in $650 billion in inflows this year. So just extraordinary. And the third reason I wanted to touch upon, the third reason that the bull market is likely to continue over the long term, is because we've got historical deals coming in. And we mentioned this in our weekly, not only with the Middle East and the US, but we've also got US-China deals being done. And of course, we've got company earnings. Company earnings are growing more than expected, and so too are company earnings forecasts. And this supports the bullish runway for stocks to continue. So they're the three reasons, the three considerations. But today, the tone is cautionary. We are expecting investors to perhaps trim back some of the gains tied to economic growth. So you might be expecting a step lower in technology stocks, real estate names as well. So I'd be watching stocks like Domain Holdings and Megaport. Remember that they're up considerably this year. 70% is how much these stocks have gained. Meanwhile, expect pivots and buying into defensive stocks and sectors. So I'd be watching gold, expecting more hot sauce or more money to be poured into stocks like Evolution Mining, Genesis and Newmont, because we need to remember that these companies do particularly well when we've got mounting credit concerns. And of course, they're doing very well with gold trading near record all-time highs. And that's the daily for stocks and ETFs mentioned. Head over to Moodys platform, you'll find plenty